Fook, Hien, every man, woman and their dog are scrambling over each other to try and get a load full of Greater China market shares right now. You know, the Hang Seng, the 8 shares, the Shanghai Composite, they've all just gone gangbusters ever since Beijing finally started rolling out a raft of stimulus measures for the economy. Is it all just looking a little bit too overbought right now in the short term, or is this a road that we really need to ride?
Well, I was going to flip that to say that it might be looking a bit overbought on the medium term, but in the short term, it is hard to say it could continue in terms of the momentum. Look, we recognize that valuation is attractive, valuation is low. A lot of the big companies are recognizing that in terms of the share buybacks and what they're doing to support their own share price. We think that's positive. And the policy stimulus, we think it really underlines that the policymakers are willing to do what is enough, right? We don't think they are actually going out with all guns blazing in terms of the full big bang stimulus, but they're willing to do what is enough, and what is enough is going to be something that keeps the economy stabilized. So they'll keep doing whatever it takes to be enough, but not necessarily, we think, in terms of a big bang stimulus. So our recognition is that, no, valuation is low and positioning was very low. So what companies are doing in terms of share buyback, that's positive. So there's a bit of rally here upcoming. But for the longer term, we're looking at still questions of deflation. Can we escape deflation? That's very much tied to consumer sentiment. Whether consumer sentiment can really turn around, as you know, that very much depends on the property market. And we do have the US election coming up, and that could impact a lot of rhetoric and headlines in terms of policies that might get implemented from the US. So these are longer term things, but in the near term, we think, because of the positioning, I think that's been driving the market a lot. And our view really in China is our, opportunistic buy idea at the moment is with your non-financial high dividend SOEs. That's the opportunity that we like within China.
And it's a real show me moment, isn't it? It's one thing to implement, it's another thing to actually have some impact. I mean, not that Fook Hien weakness in the Chinese economy or the stock markets held back any other global markets. I mean, Japan had done very well. Stock market wise, the US stock market, of course, has done very well. But that being said, now that we do seem to have some hopes for revival and stabilization in the world's second largest economy, does it change the game for global markets?
Yeah, I think we've been seeing possibly some rotation out of markets like India and Japan into China within the past week. And then, but as the US dollar, whatever happens to the US dollar, again, that could have a very big impact on emerging markets and on Asia as well. But look, I mean, in terms of asset allocation, looking out 6 to 12 months, our preference is still with the US market. For the reasons I mentioned, if we get a soft landing, that's positive. And structurally, the growth, we think, within India, that's positive. So for China, I think in terms of the asset allocation side, beyond the short term, we really need to look at the fundamentals, what happens with deflation, what happens with the policies that comes out of the US. In the short term, because the positioning has been very much underweight, within China, we saw a lot of flows coming in. And then with Japan as well, there was a bit of uncertainty with the elections there. So perhaps some flow coming out of there as well within Asia, out of Japan into China. But in the medium term, I think we still prefer to stick to markets where we can see growth that is visible and that we're confident in.